And we're back again with Dr Neil Schultz, forensic psychiatrist. And tonight we're going to be talking on this episode now about what's happening with market drivers. So what might be some of the elements that happen in market psychology as a general?
Well, the markets are driven by many things, as you know. They include the data that's being released at any given time, the context of when that data is being released with the bigger picture, be that the geopolitical background, whether or not people are trading or algorithms are trading, and importantly, the emotion versus the cognition of the people who are trading.
I mean, that has to be one of the larger sort of things that we've seen in the last sort of year. I mean, 2020, it felt like much of the market was entirely emotional, purely because of what we see in things like Tesla and Bitcoin, where it's being driven on hype and we have people having, I suppose, the fear of missing out, and then eventually that's all turned around into the fear of getting out when prices have started getting sky high and they're worried about where it's going to go next. So naturally that implies that there is some level of emotional problem, or at least emotions being active inside the actual trading side of things. So what might be some of the drivers, what might be some of the things that are going to affect this the most? If we have markets behaving in this way, what might be the counter opposite look like?
Well, when you think about what makes markets go up and down, it's people. And if it was only algorithms trading, then you would probably find that there'll be very little price movement at all.
So we'd end up with almost a flat line.
You would end up like a flat line. It's like having a heartbeat versus not having a heartbeat. So you might find that price traded by algorithms only would go up or down, but it would be very much based on the fundamentals. You know, if something's actually worth more, the price will go up. Okay. If something's actually worth less at the moment, the price will go down. But when people are involved, you introduce excitement about making more money, about what's going on, about their unusual expectations, and price will go up or down accordingly.
And what about the fear side of that? That does the same thing?
It's exactly the same in reverse.
Okay.
The only thing is that you often find that when people are responding through fear or through negative news, things go down more quickly than they go up.
So why is it that markets might behave faster in response to fearful emotions and price moving down than when they're actually moving up?
It goes back to the things we talked about in our earlier session about the physiology of anxiety. So people are, and in fact all animal species, are very sensitive to danger. So if you come across something that you perceive as being dangerous, then you will react much more quickly because that's there in our DNA as a way of protecting us. On the other side, we're not anywhere near as responsive to positive news or positive things that we see because there's no life-saving pattern or requirement of that.
That's okay. So that means that, you know, when it comes to the physiological side of things, when we are under that fight or flight, you know, very early on days of before humans were human, it's basically almost like that lizard side of our brain.
It all goes back to the basics, yes.
Now, when it comes to, you know, that fast move down in trades that may actually happen and how we respond to it, and we see that, you know, moves up tend to be slow and take their time, whilst a fast-moving market is usually on the short side, and we see very quick, sharp, short moves, just bang straight down. From a psychological and psychiatric perspective, why does that actually happen?
Well, it really goes back to what I was talking about in one of our earlier sessions. When you think about our primitive brain, so that our brain is really designed to protect us from dangerous situations, and it protects us immediately. So when you perceive something as being dangerous, you develop a fight or flight response. And that's effectively what's going on here. So if you find yourself in a market situation where the price is dropping rapidly, then you will want to get out of that market because you are perceiving it as being dangerous, and you are hardwired to respond to that quickly to protect yourself.
Okay.
And if you're doing it, then thousands, if not billions of other people are doing it at the same time, and market plummets.
And on the upside of that, I mean, if we were to look at things like what we've seen from Bitcoin and gold and perhaps even Tesla this year or in 2020, we've seen prices sort of skyrocketing. And now there's been a lot of talk in a few different circles, especially on the economic side of things, that we find people talking about this term of the fear of getting out. Now, does that same principle apply there? Or because price is going up, we're not perceiving it as being dangerous? How does that sort of look for you?
Okay, well, there are two aspects of this. Firstly, when price is rising, you're not in a dangerous situation.
No.
So you don't have those same protective measures that you would in a falling market. You don't have, the evolution of mankind to get in there and say, get out, this is dangerous. So it goes up more slowly. But I think what you're really asking is, why is it that when the markets continue to rise, maybe against what logic would suggest, why do people keep buying? And I think the answer to that question really comes back to the issue of hysteria. Now, hysteria is it's a very old term, and it really describes what happens when groups of people do things or behave in similar ways without any rational reason for doing so. So in this case, if everyone sees the market is rising, even if they can't find a logical reason for it to be happening, it's rising nonetheless. And so people will start to buy, they'll start to go along with it. And you sometimes hear it referred to in terms of a bubble forming, or mum and dad investors. So when mum and dad investors are getting the market, it's time to get out, that sort of expression. Yeah. And that happens because people are kind of getting into the market without really knowing what's going on, without understanding what's happening, but on a very emotional basis. And that emotion is bordering on like a hysterical kind of pathway.
And I suppose, when it comes to that sort of thinking of hysteria, it's almost like what we saw in the GFC with some of the bank faults that happened. We had one person walk into the bank, say that they wanted to withdraw all of their funds, and for no particular reason, on the day, someone else saw that happen, and then they decided they needed to tell their friends, and eventually it hit the media. And then from there, it just spiraled out of control, and everyone sort of decided we're all got to pull our money out of this bank. And there was no logical explanation for it, other than people just saw one person pulling a huge sum of money out. Does that count as a level of hysteria?
Yeah. That's the classical description of a bank run.
Yes.
And if you go back to the Wild West of America, they happened all the time. And yes, that is very much an hysterical reaction.
So we can almost look at the idea of when we see a bubbled market or a market that is booming without logic behind it, that it is a symptom of hysteria in the market to a degree.
To a degree, yes. So I think you could sum this up by simply saying that people drive markets, not machines.
Yep.
People are driven by emotion.
Yep.
And emotion controls price. It's really that simple.
Thank you very much again for this today. Now, for everyone back there, I hope you've enjoyed this little segment as well.